The wealth gap that we have today, we've never seen it before. And we're talking about the rich and the poor. We are seeing a divide in between these two like literally never before in history. And why is that the case? Well, it's pretty important to understand what's happening with the central banks so that you can realize how they are not only involved, but they're the reason. And if you look at this through little bits and pieces of the financial data that come through, it starts to make a lot of sense. I'm going to bring you some of that today. We're going to look at real estate. We're going to look at interest rates. We're going to look at what's happening with car loans, not so good there. Then I've got some other information I really need to show you. It all comes down to this. Wealth disparity blows out according to the Fed total wealth by wealth category in the trillions of dollars. So the top 10%, you can see 85.6 trillion, 50 to 90%, that's 34.8 trillion, and the bottom 50% has just 2.5 trillion. Now, you look at this and it would be nice to actually break that down even further. Like if you would then zoom in on the top 10%, and that's into the, the 1% or even the 0.01% and so on, it shows you that really it's the top of the top that owns everything. Now the middle class, 50 to 90%, I think that's, upper middle class into that range, they had been doing better than they were during the financial crisis, supposedly. But when you start to factor in a lot of the data, well, it's not exactly the case because inflation has been eating away at what people had been able to spend. And you see this. Just look back, let's say 1970, where people had the ability to have, let's say, 2 cars, they had a nice house that was paid down, they didn't really have much debt, and they were able to be okay on one income. Now today you have both the husband and the wife working, you've got the kids in public school, maybe they're not paying for that. Obviously the taxes are paying for it, and you can see that they're basically just doing what they can to get by, just to get by. What has happened? Well, you can go back into 1913 if you want to start with the Fed, but you can see this from 1971 where the gold standard was completely eliminated, no more gold, and they started to go ahead with maximum debt. Now that debt may not seem like anything right away, but when it starts to pile on, it makes more of a concern for the corporations taking on debt, for the individuals taking on debt, and the nations as well. It's all about how we move through a cycle, because as soon as the interest rates are hiked, then the problems start to appear. Here you're looking at retail sales facing more downside from squeezed consumers. This is ultimately what happens over time, just like in the financial crisis, as you see here. Same thing going on today. Retail sales are obviously important because the US consumer is 68%, based on the last thing I saw, 68% of the economy. 68% of the economy, if the consumer isn't buying, what do you think that's going to do overall? Well, jobs and everything else interconnected. Retail is one of the most cyclical sectors. This is showing us retail at the top of the list, technology, hardware, energy, semiconductors, and so on. But certainly, retail is there. People maybe don't need to buy that extra shirt or those extra pants during tighter times. This is the sticky inflation opening the door to steeper Fed rate hike in March. I do not agree with this, but I'm bringing it to you because I don't want my bias to come through here. I think it's going to be 25 basis points. But they're just saying it opens the door to 50. Pervasive inflation, a hot job market, and a resilient consumer have put the option of a 0.5 percentage point interest rate hike on the table when the Fed meets at the end of March. Stay tuned to this channel, hit that subscribe button, and I will bring you each and every detail leading up into it and immediately after it happens. In separate interviews and speeches this week, 2 central bank policymakers indicated that they are open to supporting a 50 basis point rate hike at this juncture. The incoming data has not changed my view that we'll need to bring the Fed funds rate up to 5% and hold it there for some time. That is according to the Cleveland Fed President Loretta Mester, who I talked about in the previous video. Now you got to look at this and realize, what does it mean at 5%? Well, if you can really think about where 5% Fed funds rate puts the mortgage rates, well, then it's a lot tighter than where we are today and where, of course, we had been just a couple of years ago. I'll show you what's happening with real estate in a second, but you got to understand that one interest rate is not the be all end all. There's so many different interest rates, and it ultimately depends on the consumer, their credit cards that they're going to use, which are approximately 20% interest right now. Look at what's going on with mortgage rates. These rates that you're seeing advertised and everything, that doesn't necessarily mean that's the rate you'll pay. Borrowing costs go up, people spend less. That's just a matter of fact. It's the same thing with corporations, and of course, countries really suffer under this as well because they have to pay more on the interest for those debt payments too. They're not let's say just standing alone in that circumstance. 30-year fixed rate mortgages, they rose from 6.12% to 6.32%. A year ago at this time, the rate averaged 3.92. So it has jumped significantly in a single year. And we can see the demand as a result of that has been, it has certainly taken a hit on the demand because people can't afford it. That's a matter of fact. But it hasn't killed the demand. It's just slowed things down. For housing markets, the rebound in rates translate into higher mortgage payments from a year ago, but lower than in the summer of the 2022 peak of the market because prices have dropped 11% over the 7 months. So people are getting in. Some people that can't afford it, they're saying, hey, all right, I'm off the peak. This is my time to get in, buy the dip. And you see that people are doing so. The buyer of a median priced home is looking at $1,985 monthly payment at today's rate. That is 42% higher than last year. Think about that. 42% up. Unbelievable. 6% lower than would have been in June 22. It all depends on, your circumstances, where you're buying, what the prices are, and so on. But think about it. If they're paying 42% more than before, that means they cannot afford the same house they did, or maybe they're not getting the most desirable area, or the school that's there is not exactly the best. So many things affecting them. And this happens when the central banks hike the way that they have been. So what is the takeaway here? Well, number one, you got to watch what happens each and every moment the central banks are speaking and acting. That's integral. And then you got to understand how the businesses, how the corporations are responding to that. Are they actually taking it into account and starting to lay people off? That's really key because it may not be your company, it might not even be in your sector, but that starts to spread. And we saw that during 2008 and 2009. That was very clear. It was a slow, even though there was Lehman, there was Bear Stearns, things did happen along the way, all the way into, let's say, 2011. The problem started appearing in 2007, notably. And then it took all the way into 2011 for so much to happen. So don't think things just happen overnight. Okay, it's just like that. It isn't. So watch these things very carefully. I'll cover all those on the channel, but you want to know where the cracks start to appear because that's likely going to be that linchpin that is pulled. Some of the cracks, in this case here, we can see some of that. Used car prices, quite significant right now. And I'll talk about car loans in just a sec. That's what I want to get to. But here you can see the Manheim Used Vehicle Value Index has now gone up again. So it was coming down, 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 and yet it has surged up quite a bit. All right, now this is the wholesale index. So essentially what we're looking at is what could be there, could be present in the coming months. In what people actually are purchasing, we will see what occurs. But why is this important? Because that's going to end up in the CPI calculations. If the CPI stays elevated, Federal Reserve is more likely to keep their interest rates high. You see what I'm saying? Why don't I just show you these charts just for fun? This is the chart GPS, I get it, but it's not just for fun. What about this? This was supposed to be included earlier. San Francisco area, Bay Area housing market crashes. Prices plunge 35% from the crazy peak. Where's the demand supposed to come from? Well, you could look at that 35% down. That's significant any way you slice it. But for most people, they hadn't been buying around that peak. So it's just to show us that when things get crazy, yes, they can turn down. That's the chart that shows us this. And it's still around these levels it was hovering at from, let's say, 2018, 2020 timeframe. Still, in my opinion, way too expensive. But what I wanted to show you was this. More auto payments are late, exposing cracks in consumer credit. Borrowers with low credit scores fall behind the numbers unseen since 2010. That's when you know you got a problem. Now, look at it in a different light, and it's not that many people, but it shows us where the cracks are appearing. We are seeing it with mortgages and real estate, and we are also seeing it in the auto loans. So both of these directly tied together, all linked with the Fed funds rate, the interest rates. The US economy is on a steady footing and the unemployment rate is super low. I'm just not going to interject at that moment. Anyway, yet a rising number of Americans are falling behind on their car payments. Some 9.3% of auto loans extended to people with low credit scores were 30 or more days behind on their payments at the end of last year, the highest share since 2010. Remember, by the way, I actually covered this like a day or two ago, so Wall Street Journal, you're a little late. You should have been watching the Money GPS. But anyway, here we go. The past few years has been unusually good for consumers. Don't forget to mention the fact that there were moratoriums, and because of that, people were able to start paying down their credit cards because they didn't have to pay their rent, they didn't have to pay their mortgage, they didn't have to pay anything. So they had a chance to start paying certain things, high interest rate things, down. There was one of the most unique times where actually credit card debt declined, which is strange in itself because people love to spend on their credit cards. 20% interest rates, I can't believe it, my goodness. Here we have it. The households that were on the financial ledge to begin with might have been tipped to the point where it's hard to keep up on the car loan and everything else, and people have to make some very hard decisions. So that's the key. That's what we're seeing right now. You can see the chart on the left-hand side, which just shows us from 2006 up until the present, the share of outstanding subprime auto debt that is 30 or more days delinquent. Now, you might say to yourself, well, that's only 30 days, or that's only a group of people, or the percentage is still small. That's how these things work. They start one sector, one area, one little tiny thing, and the ripple effect or the domino effect then takes over. But we don't know that. We don't know that this is going to be the next crisis. But it's something to pay attention to. That's all I'm trying to say. All I'm trying to say at this point here. Let's look at the next issue really quick, where you can see that fake EBITDA. I'm not a fan of that word anyway, but it's just basically earnings masks risks in debt-laden companies. The S&P says earnings forecasts in mergers and acquisition deals are far too rosy. Also, the big rally in Chinese developer bonds is losing steam. Both of those are covered here. If you want to know this in full depth, besides reading this article, you could check out a book called Infectious Greed, one of my favorite books of all time. Infectious Greed. During the days of easy money, one of the most widely tracked numbers in credit markets became an unfortunate punchline. EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, a figure that's akin to a company's cash flow and thus its ability to pay its debts, was instead mocked as a marketing gimmick when bankers and private equity firms asked investors to buy a piece of their loan, funding buyouts, and other transactions. They would layer on so-called add backs to the earnings projection that to some defied reason. This is the kind of thing that you see, these funny accounting gimmicks that make these companies look so fantastic, and yet anybody looking at that knows it's BS. They know that. They're not going to believe it, right? But for some, when doing a SPAC deal, for instance, nobody knows what's going to happen. They're just throwing money in. And these are the dangers that we could encounter. That's why you shouldn't just, I'm going to buy this company based on that. I'm going to buy Tesla shares because of this. You're not even looking at the financials properly. I mean, it's so risky. It's so dangerous, but people do it anyway. That's the way things work. Watch out very clearly. The message of this is that you got to do your own real, actual due diligence, not the nonsense from Reddit. Treasury bills offer stock like 5% to take the Fed and debt limit risk. You got to understand here, think about it. If you're going to go into the stock market right now, really, what are you going to get out of it? Are you going to see that real good takeaway? Or is it simply a matter of, we don't know what's going to happen? Well, right here, 5% quote unquote guaranteed. And we haven't seen this since 2007. That just shows us that what's happening in the bond market today is quite different than anything we have seen in a long time. And that's all because of these interest rates. So when we follow the interest rates, when we follow the patterns, we start to see how this affects everything from auto loans to the mortgages to the bond market and basically all throughout the financial system. Real important. It affects jobs. It affects the corporations, the companies, small and large. I hope you appreciate this information. If you did, hit that subscribe down below because tomorrow you're definitely going to want to check out what I have. I'll see you then. Take care.